the following information related to Marshall's year-end account balances at 12/31/17. So these are year-end balances for 2017, which will of course be beginning balances for 2018, and the following transactions that happened during 2018. And we're going to prepare journal entries to write off uncollectible accounts, as well as setting up the allowance for doubtful accounts using the percentage of sales method and the percentage of receivable methods. Let's begin by preparing our journal entry to record the write-off of uncollectible accounts. We're told that actual write-offs deemed uncollectible were $12,000. When we write off receivables, we credit accounts receivables. Again, that's when we actually tear them up and decide they will be a specific receivables uncollectible. The other half of the entry is to the allowance for doubtful accounts. And again, the matching principle requires us to record bad debt expense in the period when we make the sale, rather than when we actually write off the accounts receivable. So when we write off the receivable, there's no entry to the expense. The expense entry happens at the end of the period when we establish the allowance for doubtful accounts. Let's go ahead and look and see how we would do that using the percentage of sales method. We're going to go ahead and prepare the journal entry to record the allowance for doubtful accounts if the percentage of sales method is used, and management estimates that bad debt expense is equal to 2% of net credit sales. The first thing to remember is using the percentage of sales method, we only pay attention to income statement accounts. That is, our credit sales, sales returns, and sales discounts. And we can see our net credit sales in this case are $1,120,000. That's simply our sales less the returns and the discounts. Our bad debt expense then is simply $22,400. It's the net credit sales times our 2%. The other half of the entry then is a credit to the allowance for doubtful accounts. We aren't concerned with what the current balance is. It's simply we calculate the bad debt expense, debit the bad debt expense for that amount, and credit the allowance. Again, only using income statement accounts in our calculations. Let's go ahead now and prepare our journal entry if the aging method is used and management estimates that the uncollectible receivables are 15% of the year-end balance. We need to begin by calculating the year-end balance in both our accounts receivable and the allowance for doubtful accounts. We have a balance sheet focus. We begin by picking up the beginning balances in accounts receivable and our allowance for doubtful accounts. Recall, these are simply the ending balances from the prior year. Next thing we need to do is record our write-offs of receivables during the year. Recall, we had write-offs of $12,000 and we credited accounts receivable and debited the allowance for doubtful accounts. Next, let's go ahead and record our cash collections, or rather, net credit sales. Our net credit sales were $1,120,000. Recall, it was sales minus our returns minus our sales discounts. Now we can record our cash collections. We're told that cash collections are $1,100,000. Next, we can total the ending balance for accounts receivable, and we see that's $108,000, and our ending balance for the allowance for doubtful accounts before any adjustments is a $3,000 credit. We were told, again, our estimated reserve should be 15% of year-end accounts receivable. So we simply multiply the $108,000 by 15%, and we get an estimated allowance of $16,200. That's what we want for our ending balance in the allowance for doubtful accounts, and we can see that requires an adjusting entry then of $13,200. So we credit the allowance for doubtful accounts for $13,200, and we record an expense of $13,200. Let's consider one final question. At the end of last year, was management overly optimistic or overly pessimistic in estimating the allowance for doubtful accounts? How can we tell, and what impact did last year's estimate have on current year's net income? First, last year's allowance was $15,000 and the accounts receivable balance was $100,000. This means that last year the firm set aside 15% of receivables. But notice or recall that we only wrote off $12,000 in accounts receivable. That means management was overly pessimistic regarding collections. And by overstating the allowance last year, the current year's bad debt expense will be lower, and its reported net income will, of course, be higher. We can see that by looking at our allowance for doubtful accounts. Again, last year we set aside $15,000, write-offs were only $12,000, leaving us a credit balance. So this year our adjustment only had to be $13,000 rather than the higher amount of $16,000 because we had an amount left over from the prior year.